But there's two things happening here. One over here, which we're hitting on right now, is this speed of how fast rates will go to the Fed's target level next year. So Fed thinks we're getting there in 2 or 3 years. Mark says 1 to 2 years. Okay, that's one idea. Idea number two, which I actually find more interesting than the longer term construct, is everybody agrees, the market and the Fed, that the terminal Fed funds rate is going to be called 275. Okay, where does that come from? That comes from their belief that inflation will be 2.25, somewhere near their target, and they're going to put on a 50 basis point real rate. So that gives them the Fed funds rate at called 275, somewhere in there. Traditionally, Fed funds to 2 years is 50 basis points. That puts your 2-year rate at 3.25. Okay, 3.25, somewhere there, which is where forwards already are. But 2s, 10s usually is 75 to 100. That puts the 10-year up to about 4%. I don't see how 10s go a whole lot more than where they are right now. So we can all fight about this front end, how fast it will get there, but everyone seems to be in agreement upon the back end, unless you're going to see a flat to inverted curve out in the future. I suppose it's possible. I mean, what that's really saying, kinda, is that, I mean, the people who think that the 10s can move a lot lower than 3.5 is that the funds rate's going to 1. I don't see it happening at all, unless we hit, once again, not hard landing. I'm talking crash landing. You need a crash landing to get back to 1%, because that would imply almost deflation, as well as a recession, which I don't see happening.